So, if you've got a 401k or a mutual fund, chances are you're paying for something called active management, right? It's this promise that an expert is going to beat the market for you, for a fee, of course. But here's the thing. For millions of people, this system isn't just not working, it's costing them billions. So today, we've got to ask, is that expert fee really worth it?
Okay, let's just dive right into the deep end here. Every single year, investors like you and me, we pour billions, with a B, into fees for these actively managed funds. And we do it hoping, kind of expecting, that these super smart, highly paid managers are going to work some magic and outperform a simple market index. But does that hope actually match reality? Well, the data tells a pretty shocking story.
Take a look at this. This is the hard data from Spiva, which is basically the industry's own report card. In a year where the S&P 500, just the plain old market, returned 15%, the average big company fund did worse. And get this is not a fluke. It's not a one-off bad year. The data shows that whether you look at 1 year, 3 years, or even 5 years, the vast majority of these expert stock pickers consistently fail to beat their own benchmark.
So here's the bottom line. The financial industry is collecting billions of dollars from hardworking people, promising them they'll do better than average. But the numbers show they often just deliver average performance, or sometimes even worse. You're literally paying a premium price for a mediocre product. Now, this isn't to say the managers are bad people. It just points to a huge systemic problem in how we're all taught to invest.
All right, so here's our game plan for today. We're going to start by talking about the high costs of just hoping for the best, and this idea of the illusion of control. Then we're going to get into a whole new way of looking at things, the 4 pillars of investing. We'll cover how to know a company's value, how to read the story the market is telling you, and finally, how to master your strategy for cash flow and risk. Let's do this.
So why do we keep getting caught in this trap? Why do we keep paying more for less? Well, it's not because the fund managers are out to get us. It's because the whole system is built on an illusion. The illusion that if we just give our money to someone else, we're somehow more in control of our financial future. But in reality, the moment you hand over your money, you're not gaining control. You're giving it up.
This quote from Robert Kiyosaki, it just hits the nail on the head. When markets take a nosedive, the people who lost the most were the ones who had outsourced all their financial thinking. They watched their wealth just evaporate. They had handed over the steering wheel, and suddenly they were just passengers on a terrifying ride they had no control over. And that right there is the heart of the problem. Real investing isn't about being a passenger. It's about being the pilot.
And this chart just lays it out perfectly, the difference between just hoping and actually building. I mean, look at the left side. You can't control which way the market is going to go tomorrow. You can't stop a natural disaster or know what a company is going to report for earnings. And you definitely can't control what the government does with its fiscal policy. A strategy based on hoping all that stuff goes your way? That's not a strategy. That's just luck. But look at the right side. You have 100% control over your financial education. You are totally in charge of the strategies you learn and use. And you have absolute control over your exit plan for every single investment. That's the huge shift from being a passive hoper to an active builder.
So how do we make that shift? How do we go from being a passenger in the backseat to being the pilot in the cockpit? Well, it's not about relying on gut feelings or chasing hot stock tips. It takes a systematic process, a framework that gives you the power to make decisions based on clear criteria, not just raw emotion. And that's where we can introduce a new way of thinking.
And this framework is what we call the 4 pillars of investing. Think of it like a simple 4-point checklist you run through before you make any investment. Pillar 1, fundamental analysis. That's about knowing the real health of the company. Pillar 2, technical analysis, is about understanding the mood of the market itself. Pillar 3 is all about your cash flow strategy, how you're actually planning to make money. And Pillar 4, which is arguably the most important, is risk management, your plan for protecting yourself when things inevitably go wrong. When you put them all together, they create a complete system for taking back control.
All right, let's dive into Pillar 1, knowing your value. This is all about fundamental analysis. I mean, think about it. Before you buy a used car, you pop the hood, right? You check the engine, you look at the mileage, you want to know what you're actually paying for. Investing should be exactly the same. You need to look at a company's financials to figure out if you're getting a good deal or just buying a lemon.
Okay, let's look at a quick example. Here we have 2 companies, and they both have a PE ratio of 14. All that means is for every dollar the company makes in profit, the market's willing to pay $14 for a share. So on the surface, they look like they're valued exactly the same. But
when we look at the PEG ratio, which actually compares that price to the company's growth rate, the whole story changes. For Apple, you're paying $1.55 for each little unit of growth. But for company B, you're only paying 61 cents. So, which one is the real bargain? Knowing the true value is step one, but step two is finding out if the market agrees with you.
And that brings us right to Pillar 2, reading the story. This is what's called technical analysis. Now, I know a lot of people see stock charts and think it's some kind of voodoo or like trying to read tea leaves. But really, a stock chart is just a picture of human emotion. It's the story of the constant battle between buyers and sellers, between supply and demand, between fear and greed. And if you learn how to read that story, it can give you incredible clues about what's likely to happen next.
So this story is basically written with two words. The first one is support. A support level is simply a price where buyers get really excited. They see a deal, they jump in, and all that buying creates a floor that stops the price from falling any lower. You can think of it as the market collectively screaming, "Yes, we love this price."
And the exact opposite of that is resistance. This is like a price ceiling where sellers start to take control. They think the stock is getting a little too pricey, so they start selling, which stops the price from going any higher. This is the market collectively screaming, "No, that's way too expensive for us." And honestly, the entire up and down movement of a stock is just a dance between these yes and no levels.
So, what happens when these signals start to repeat? Well, that's when the story gets really interesting. Look at this pattern called a double top. The price goes up and hits that resistance ceiling. The market says no, and it falls back down. Then it tries again, rallies back up but hits the exact same ceiling and gets rejected a second time. A single no could just be a fluke, but two no's in the exact same spot, that's a huge signal that the buyers are running out of gas and the trend is probably about to reverse.
And this right here is one of the most powerful patterns you'll see. It's called the kiss goodbye. So, imagine you have a really strong support level. That's a yes price, where buyers have always stepped in. But then, the stock price breaks below it. The floor just gives way. Then, the stock might try to rally back up to that old floor. But this time, the whole mood is changed. That old yes level has now turned into a new no level. It's become resistance. It's like the stock is coming back up to kiss its old support level goodbye before it heads much lower. This is often the final confirmation that the whole trend has changed from up to down.
Okay, so let's get to the final two pillars, and honestly, these are the most critical ones. This is where all that analysis turns into action. If knowing the value and reading the market is like being a scout on a mission, this next part is where you become the general, the one who makes the plan to generate income and, most importantly, to protect your money. This is what really separates the amateurs from the pros.
Just look at the night and day difference in how amateurs and pros handle risk. The amateur approach, which is what most 401k plans teach us, is basically to diversify and hope. The strategy is buy and hold, and if the market crashes, just cross your fingers and hope it comes back eventually. Professionals, though, they play a totally different game. They actively manage risk. For example, they might use things like options contracts that literally act like insurance policies on their stocks to protect them from a big drop. They never get into a trade without knowing exactly where they'll get out if it goes against them. One is based on passive hope. The other is all about active control.
Professionals also know that there's more than one way to make money in the market. Most people in mutual funds are only playing one game, capital gains. Buy low, hope it goes up, sell high. It's like flipping a house. But an educated investor also has strategies for cash flow, generating regular income from their assets, kind of like renting out the house. And here's the real game changer. They even have strategies to make money in a sideways market, when a stock's price is just going nowhere. This is a huge part of the market that most people are completely missing out on. Having a plan for all three market conditions, up, down, and sideways, is the mark of a true pro.
And you know, the most important thing to get from all this is that this entire framework, it's not about having a crystal ball. You don't need to predict the future. In fact, trying to predict the future is a loser's game. All you need is a plan for the different possibilities. For every single investment you make, you have to define three things before you ever put a dollar down. Your entry point, your target for taking profits, and your exit point if you're wrong. That's it. That's discipline. That is control.
Which brings us right back to where we started. It turns out there are two very different kinds of active management. The common one that we all hear about is really about being passive. You pay someone high fees, you give up control, and you hope for the best, which, as we've seen, usually doesn't work out so well. But there's a new definition, a much better one, and that's being active in your own financial education.
taking control of your own decisions and using a system like the 4 pillars to build your wealth on purpose. It's a fundamental shift from outsourcing your future to owning it.
So the last question is really for you to think about. When you look at your own money, when you think about your financial future, are you really in the driver's seat? Are you building a plan based on a system, based on education? Or are you just a passenger, paying a really high price for a ride to a destination you can't even control? The choice, in the end, is yours.